In this video, I'm going to give you a quick, easy breakdown on how I pick dividend paying stocks and how to avoid a dividend trap so you don't get burned in the future. Because the ultimate goal here is to be able to count on this monthly income every single month for the rest of your life. What's up? Welcome back to the channel. And if you're new here, welcome. My name is Johan Lorenzo, and in this channel, I help people improve their finances and build their wealth in the stock market. Make sure to subscribe and hit that notification bell so you too can be a part of the finance community. Let's get into the video. Here are the major key points I look for when picking a dividend stock. They're not in any particular order, but here's all 5 of them. Number 1, how is the stock trending? Number 2, what is the dividend yield on the stock? Number 3, how's the history of dividend payments? Number 4, the payout ratio. And number 5, what's the market cap? So let's go over these one by one. Number 1, how is the stock trending? Even though a lot of companies pay a decent dividend, it doesn't necessarily mean you should be investing in them. I like to invest in companies that have been trending upwards over the years. This way, not only do I get paid consistent dividends, but I also make money on the stock appreciation as well, in case I ever decide to sell those shares one day in the future. I like to look at multiple time frames to track the company's progress throughout time. From short term to long term, I'll look at the daily, the weekly, the 1 month, the 3 month chart. I'll also look at the 1 year, the 5 year, and I'll even take a peek at the overall performance, basically going all the way back from the time the company went public in the stock market. As you can see, with Webull, it's very easy to check this out. Number 2, what's the dividend yield on the stock? This is where some people go down that rabbit hole chasing high dividend yields and they end up getting crushed. A higher dividend yield doesn't necessarily mean a better investment. Sometimes that comes with great risk and even more stress on the company to meet financial requirements in order to pay that hefty yield every year. Companies with high yields are more likely to cut their dividend or reduce it. I like to call these the dividend trap. My comfort zone for a dividend paying company is anywhere from 6 to 7%, max. Preferably anywhere between 2 to 5% is the sweet spot. Sometimes companies with lower yields are better growth stocks, like Apple for example. Very low dividend yield, but you can expect that stock to explode much higher and quicker than a stock like Coca-Cola. Coca-Cola pays a much higher yield than Apple, but they'll grow much slower over the years. Finding a good balance in your portfolio is key. A good mix between growth and dividend cash cows. That's what I look for. Remember, the dividend yield is a percentage you're going to get paid yearly. It goes hand in hand with the stock price and it fluctuates constantly. If the stock dips in price, the dividend yield will go up. If the stock rises in price, the dividend yield will go down. Numero tres. What's the history of the dividend payments? The longer the track record here, the safer the stock is in my opinion. Obviously, you can't base everything just off this, but if you have a stock that's trending upwards over the years with a solid dividend yield between 2 and 5% and has been paying a consistent dividend for, let's say, 20 years plus, you've got yourself a solid investment opportunity to grow your money and create that dividend cash flow you can count on throughout all types of market conditions. Number 4, the payout ratio. This is very important in figuring out if the stock you're investing in is at risk of cutting or reducing their dividend. You can find this out with a simple Google search. This number can mean something different in different sectors of the market. For example, an 80% payout ratio might seem high for a consumer staples company, but might be a decent number for a REIT, a real estate investment trust. The perfect number here for me would be anywhere between 50 and 60%. Those are what I consider sleep well at night numbers. But I do feel comfortable investing in companies that pay a higher ratio as well. Anything above 80% for me, I try to make sure I stay on top of the company and stay up to date with their news and quarterly earnings. So let's go on to good old number 5. Bruh man, from the 5th flow. Let me know in the comments below if you know what show that's from. But number 5, we have market cap. What is the company's market cap? I personally prefer to invest in large cap companies for my long-term dividend portfolio. These are companies that are valued at $10 billion or more. Investing in these companies pose less risk in exchange for less aggressive growth. Large cap companies tend to be very stable companies and usually dominate in their industry. For now, I'll be mainly investing in large cap companies because I want to guarantee as much of my cash flow as possible for my future years. I need this cash flow to be consistent and continually grow throughout the next couple of years. So for now, more than 80% or so of my portfolio will be invested in large cap companies. The most important thing to really remember here is, if it looks too good to be true, it's probably not a good long-term investment. A stock that's paying you a 12 or 13% dividend yield is probably a dividend trap. They're gonna try to appeal to you with that huge dividend yield because they're lacking in other areas of their business. So they try to attract novice investors with that fat dividend. If you're experienced in this game, you'll know better than that. If you're not and you don't listen, you're gonna learn the hard way chasing those huge dividend yields. The worst feeling is to invest in one of those companies and a few months down the road, the company cuts their dividend and your shares are down 25%. Your hard-earned money is now a dumpster fire. That situation would be best described in the words of DJ Khaled: you played yourself. Everything we covered here today, you can find out with a simple Google search. You can Google these different points to find out everything you need to know about that stock, or you can sign up for a program that does the work for you. I really like Simply Safe Dividends. This is not a paid advertisement for them. This is just my opinion. They're really good at helping you track and stay up to date on your portfolio. They basically do all the legwork for you and keep you informed if any of your companies make an announcement or change anything at all. I'd recommend them to all my friends and family. They have a free 2-week trial. I'll leave the link down in the description below for you guys. Don't forget to smash the thumbs up for me, guys. It helps me out in a major way. And don't forget to subscribe if you haven't done so already. I hope this video brought you some value and hopefully makes it a little bit easier for you guys to navigate this world of investing. Thank you guys so much for watching. I really do appreciate each and every single one of you. Until next time, peace!